Is should you be in a higher tax bracket down the line, you won't have to pay higher taxes down the line. So you're banging it out at the front end. You're banging it out at the back end when you're retired. You are accounting for all systems and areas of your life. You don't know what the future holds. You do know now what tax bracket you're in. I was raised with the notion of work a 9 to 5. Have that money to pay your bills, and if you're lucky, take a vacation once a year with your family. So it goes 9 to 5, funnel it to bills, and maybe you have a small emergency fund or take one vacation a year if you're not working paycheck to paycheck. And I thought, this is not a way to live life. I mean, a lot of people are struggling just to put food on the table. This is a very legitimate place that a lot of people are in. And I thought there needs to be a better way. Kat, where did you learn about this? I gotta admit, this topic was the most boring topic I've ever heard about in my life. Financial management was not sexy. You guys, I don't want to be stuck in finances and interest and ROI and the stock market and real estate. I don't want to talk about that stuff. I want to talk about people's souls. But here's the thing about financial freedom. I want to make this very clear. If you are able to make your money work for you without you having to be physically present, and that's what Rich Dad, Poor Dad talks about by Robert Kiyosaki, you don't physically have to be there. You can be traveling the world, interviewing people, asking people about their stories, being on a farm, raising children, having your money work for you. You gain the freedom of your time. All of a sudden, people are listening. The mindset shift. You're no longer an employee. You're a founder of your own time and business. When it comes to, and I'm looking here at the camera, we're on TikTok Live. When it comes to financial management, it's all about having your money work for you. If you are working paycheck to paycheck, okay, here are the 4 immediate things. You're not going to see a get rich quick scheme. I repeat, this is not a short-term get rich quick strategy, because when you're talking about investments, things take time to build and to compound. My company at the time had a 401k. Raise your hand if you have a 401k. This is retirement planning. You're contributing every paycheck to a fund that you cannot touch unless there's an emergency until your retirement, okay? And at the point of retirement, let's say you're 65, you've worked your ass off, now you're ready to cash in on that 401k, you get taxed. You get taxed at whatever tax bracket you're in at the point of retirement. So my company had a 401k. The first thing I did was I maxed out my contributions. If you have a company matching program, sometimes they match 3 to 5%, whatever that matching is, take advantage of it. Max out your contributions. Every year, the contribution limit changes. Once you max it out, your company's match will be free money that adds on to whatever you're contributing. So I maxed out my 401k. My company matched it at whatever percentage they matched it at. And I said, great. Well, I'm not going to just stop at that. And if you don't have a 401k, the next part is for you, okay? I'm going to get a Roth IRA. And you can do this through Fidelity, and there's a number of other financial institutions that will let you set up a Roth IRA. And really what the difference is between a 401k where you're taxed at the point of retirement, at whatever tax bracket you're in, you're rich, you're poor at retirement, inflation, you don't know what the future holds, you're going to get taxed at the point of taking that out, is that with a Roth IRA, you're taxed now, meaning that you can let your money grow in it for as long as you have it in there. So now you have a 2-system strategy. Raise your hand, TikTok Live, if you're with me with 401k and IRA. All right, we're seeing a lot of people joining. They're like, who's this Kat person running her mouth? All right, Kat, well, that sounds like I'm just contributing to things for a future self. How am I actually supposed to make money off my money? All right, here's the next part of this. If you're with me so far, your paychecks, instead of having it blown on whatever it is, lots of people use it to do Uber Eats and they're not disciplined. Can you put $100 for me per paycheck into a high yield savings account? You can do it through Fidelity. You can do it through Ally Bank. A ton of banks have interest rates that pay you between 3 to 4%. That's way better than most banks that pay 1% or less of your bank that's just sitting there dusty collecting cobwebs. Can you move your money into a high yield savings account? Okay. And then once you do that, let's just say it's $100 per paycheck into this high yield savings account. Can you then, stick with me, have automatic contributions into the Standard & Poor's S&P 500's index funds? Kat, what do you mean stock market? You told me on this podcast we're going to actually learn about financial management, and now you're telling me to enter into the stock market? That's the worst advice in the world. Why would you tell me that? Here's the thing about index funds, okay? And there's a great book by J.L. Collins, which is The Simple Path to Wealth. J.L. Collins, get that book. What is the S&P 500? It sounds like a racetrack. It's not. It's essentially a diversified mix of stocks across U.S. industries, from oil to motor, gas, okay, electric, all kinds of different industries, automotive. And it's the safest way to invest in the stock market easily without having to pick your own hero stocks. Kat, but I've heard that Nvidia is so good in the stock market. Why can't I just choose a few hero stocks? I'm not your mother. I'm your friend, okay? Do whatever the hell you want to do. But there's risk involved. And I'm talking to the 9-to-5ers who simply are scared to start financial investing at all. Or I'm talking to the people who are self-employed, barely making it by. I'm not telling you to start betting on certain stocks. I'm telling you, go into the S&P 500, get your feet wet, do all these other investments with your high yield savings account, start to make money, and then you can play around. If you have an extra $50, sure, put that towards a hero stock. Jim Cramer in How to Make Money in Any Market, he is very smart about how to choose hero stocks, which are winning stocks that at the right time, at the right place, they're going to blow up. And there's a whole strategy to do it. Read this book if you want to learn more. I just personally don't have the time nor want to learn about hero stocks. I'd rather do the S&P 500 and take risks in other places like real estate, okay? And I want to pause on that for a moment because I was freaked out investing in the stock market. My dad was a day trader, and I remember him coming out of his room at 6 a.m. because when the stock markets open in the morning, it just depends on what time zone you're in, you're freaked out. You're like, oh my God, I got to do these trades. And every day there's different trades. And sometimes you're losing a ton of money. And he would come out of his room, I just remember in the morning, and he'd be pulling his hair out. If you're investing hundreds and thousands of dollars into the stock market and there's a dip, say goodbye to $5,000, $10,000 in one day. And that's on the lower end. If you have more money in there, you can truly kiss money goodbye if you're looking at a dip and then you're pulling money out. Day trading is just so in the weeds. You have to know what you're doing. And the thing is, the market is unpredictable. And with hero stocks, figuring out, like people say, Nvidia stock, go after this one stock, right? GameStop, The Big Short, where they're betting against one particular stock. That is such a headache for most people. I would not recommend it. So what J.L. Collins says is go into the lowest barrier to entry, which is the S&P 500. Let's just say $100 from the high yield savings account and you're trickling in, let's say $50 into the S&P 500. You can get fractional shares. You no longer have to buy the full share of something. You can do a fractional share. If it's $10 every week into the S&P 500, consistency is more important than finding the right stocks and trying to time the market. Dollar cost averaging, meaning if you're putting $10 or $50 into the stock market consistently every single week, if there's ups, if there's downs, if the market's consistent, it doesn't matter because you're consistent. And if you're contributing, right, at a status or a level that is consistent, if there's ups and downs, your contributions catch you when the shares are higher. And even when the market dips, you're not sunk because you're on average beating out the people that are on their highest highs, trying to time the market and then dipping and pulling out. You have to allow your money to set it and forget it. So you have to be able to say, and let's just say you're working paycheck to paycheck, I'm going to be okay with putting $50 a week into the S&P 500 and not checking it. I remember I did that. And I was like, oh my gosh, what's going to happen to my money? So if you're younger, you have more risk tolerance. You can let your stocks sit there for 10, 20 years, even 30 years, okay? And you will make money. J.L. Collins says this is the best strategy to make money. And if you're older, you can look into bonds. Bonds usually are with government contracts and they're lower risk. Let's say you buy a bond for a certain amount, you let it sit for 9 months, there's an interest rate that you're paid out with. And that's another way to go, but it's not as lucrative as other mechanisms. But Kat, what do you mean compound interest? What does this even mean? Compound interest is letting your money make interest and having that interest reinvested so your interest makes interest. Who's with me? Who's with me so far? I'm recording on TikTok and I don't know what people think, but I'm just going with it. Making your interest make interest. Wow, that sounds amazing. So all of a sudden you're in the stock market and you're getting dividends, which are payouts that certain companies do for being a shareholder, even if you're a fractional shareholder, right? And you'll take those dividends and you'll go into the brokerage accounts that you're in and you'll say, option 2, reinvest my dividends back into the stock market to buy more shares. Okay, so never just let your money sit. Constantly take the dividends and pour back in, pour back in, pour back in. Use apps like Empower to track your finances. Continually track all the financial things that you're doing, whether it's your IRA, your 401k, the S&P 500, bonds that you're doing. Track where your money's at which institution, and how much interest you're getting. And then there's other resources. There are podcasts. I listen to Bigger Pockets. Bigger Pockets is a great podcast if you want to start to learn about real estate. But Kat, real estate is so risky. You don't know who your tenants are going to be. You don't know if you can pay your mortgage on that family unit property. You don't know if interest rates are going to be sky high when you're trying to close that deal. How do you calculate cap rates? There's all these things that go into real estate, and that could be its own separate podcast. But Bigger Pockets is a great way to learn about real estate. And they have a resource organization that they partner with called Rent to Retirement, which allows you to invest in turnkey properties in different states in the United States. And apologies to my global viewers on TikTok who are like, Kat, all your different plans and strategies are US focused. If you're a global entrepreneur who's made money in Dubai or India or wherever you are in the globe, put in the chats, put in the comments. Let me get you on my TikTok is how did you make money in your local region? I'm talking about US because that's what's worked for me. None of this is without risk. And that is why I say, if you're looking for a get rich quick, stop listening to me, because all these things take your own education, listening to podcasts. And then if you're going to do rent to retirement, you need to be hiring a private inspector to inspect these turnkey properties, then you need to be actually managing the property managers all around the different people that are in the area of the market that you're investing in, and just get to know the local demographic. Real estate is a whole bag in itself, and I was able to find a partnership that allowed me to be a silent investor with minimal effort. If you pay people, this goes across everything I'm saying. If you pay people to manage your finances, to pick your stock, to pick your rental units, there may be a conflict of interest. Nobody cares more about your money than you. Okay, so that stock picker may be incentivized to sell you on certain stocks, or that financial planner may be incentivized to sell you on certain products or tiers so that there's higher fees and that they make more money. That real estate company that's having you silently invest has their own motivations. And the co-host of this Bigger Pockets podcast, Brandon Turner, came out with a book, and he talks about what it means to actually have rental properties, because you can make so much money in real estate, but there are going to be headaches. Okay, whatever investment you're in, there are going to be some kind of headaches. You have to say, here is what I value, and here is how I'm going to choose to invest my money. Every person has a different investment strategy. There's also the Khan Academy. But Kat, I don't understand terminology on real estate. Go to the Khan Academy. I've been using the Khan Academy since I was failing chemistry in high school to learn about mole conversion, which I've never used in my entire life, the chemistry I learned in high school. Then we have the Investopedia. That's a free guide. It's almost like a real estate Bible where you can learn about good financial planning. So get financially savvy, because no one cares more about your money than you. I know for me, the biggest takeaway was not even how much money I ended up making, where I could quit my corporate job after 3 years. It was the amount of boring stuff I had to learn up front, okay, years of this, to then get time back to do what I love. So if you enjoyed this podcast on financial management, please give me a like and a follow. That's it for this podcast. Thanks so much for watching, and we'll talk soon. Thank gosh.